Good evening. When Luca mentioned that he needs to fill the speaking slot for this event, I gladly accepted, but also bearing in mind that we had a contingency in the background, which was Greece. Now that Greece has reprived, we can look forward more to a discussion about capital markets, clearly. And what I'd like to do is canvass kind of the macro-financial environment, but also focus particularly on covered bonds, securitization, and how the complementarity can help create jobs and stimulate investment. So first of all, I think it's helpful to set the scene in terms of macro-financial background. The recovery in the euro area is still weak. There's a risk of stagflation. At the same time, we see weak aggregate demand that's pulling down inflation. And by inflation coming down, it raises current and expected debt burdens, real debt burdens. Now that's bad news. That's bad news for investment, particularly so if you see contracting credit, borrowing costs are high in real terms still and rising, and growth expectations are being depressed. Now what are the policy challenges arising from this? Well, we believe that we need a comprehensive strategy to tackle this dilemma at the moment where we stand at this juncture. Stimulating demand through further monetary easing, and clearly lifting inflation. That is really crucial and frequently downplayed, particularly at by the fringe of some public outlets, I should say. But bringing up inflation back to trend is very important. Second, fiscal support within the Stability and Growth Pact, and now with the Fiscal Compact, and then structural reforms that relate to improving flexibility in product and capital market, product and labor markets. But above all, what we believe is important here is for a robust recovery to take hold, we need to further clean bank balance sheets, lower impairment levels where impairment levels are too high and have risen to levels that really suffocate economic recovery. And then also further integration of capital markets. And I'll speak to that as well. So how is that connected to covered bonds and securitization? The development of covered bonds and securitization markets will influence the effectiveness of monetary policy stimulus aimed at resolving those current policy challenges I've highlighted. For monetary policy, covered bonds and securitization have already provided a stepping stone by way of private asset purchases in the evolution of QE in the euro area. And they will further support the asset purchases by the ECB as they expand the QE program to include sovereign debt. The second point where covered bonds and securitization, what I call asset-based finance, will be crucially important, is catalyzing the integration of capital markets, broaden investment opportunities, but also broadening and diversifying the sources of funding. This involves three aspects. One, improving the monetary transmission channel, which is weak at the moment, and having a system with more market-determined interest rates will make the system more nimble in times of crisis. Second, broadening the funding sources and enhancing financial stability. And finally, an aspect very dear to us is stimulating the rebalancing within the euro area. And here, the cross-border flows are important. Unfortunately, at the moment, we still see a great, should I say, divergence between what is truly cross-border investment and national banking sectors. National banking sectors are largely dominated by local banks with local owners and a local constituency. Ideally, the capital market union would drive cross-border investment and also, thanks to the SSM, cross-border liquidity. Now let's turn to monetary policy quickly. So the burden at the moment is squarely placed on monetary policy, and that's for a good reason. The European Union, and Luca, I'm sure will find another story for that, is founded on the premise of monetary dominance. So this is a another way of saying central bank independence. The ECB should be acting independently of fiscal constraints and ideally have a supportive structural underbelly, such that monetary transmission is effective and powerful and can stimulate investment and monetary policy choices. However, at the moment, we still see a high degree of financial fragmentation. So the ECB needs to act, clearly. How can it do that? Well, as we are at the zero bound, as we call it, the only way to do this, really, plausibly and suitably, is expanding the balance sheet, QE, quantitative easing. And why do we need that? Well, quantitative easing is about raising inflation expectations. This is crucial in an environment where we have high indebtedness in the non-financial sector, and the banking sector is still deleveraging. But also, low inflation makes companies delay investments. In fact, low inflation or deflationary pressures reward you for doing nothing. They reward you for holding cash balances if you have the ability to hoard cash, hence a negative deposit rate. So what we need is QE to stimulate risk-taking in the economy, providing the funding that's right now in deposits to support productive investment. So far, cover bonds and securitization have been instrumental. Now, the market mechanics have been distorted, and we all recognize that. But there was a price effect, a direct pass-through of cover bond prices and to some extent ABS. However, what private asset purchases in the first wave of QE, I should say, has achieved, not achieved, is raising aggregate liquidity. Now, why is that important? Aggregate liquidity will push up inflation. So, and the price effect really hasn't done that. So what's next? Sovereign QE. So based on the Governing Council's decision on January 22nd, we'll have sovereign QE starting on March 11th. And sovereign QE should, as I mentioned, has the key purpose of raising inflation expectations. How can it happen? By virtue of buying sovereign assets, the ECB and the Euro system hopes to stimulate risk-taking by assuming that banks, insurance companies, other institutional investors, and foreign investors recognize that money is not a perfect substitute for their sovereign asset holdings. So ideally, they would move elsewhere and possibly move in riskier assets. Now, if done right, and purchases are done at the longer duration, it creates risk-taking and amplifies risk-taking because you would be going for risky investment to cover your duration shortage. So what's the role of ABS and cover bonds here, in addition to the private asset purchases? Cover bonds and ABS could be the target of greater risk-taking. And why is that important? Well, it provides that very transmission channel, what we call the portfolio reallocation channel of QE. But also, asset structures that are unprofitable at the moment might become profitable, particularly in a negative yield environment, which, by the way, could generate real positive yields given deflation at the moment. It also supports, besides cover bonds, for instance, as a proxy for government debt, it supports the issuance of longer dated issuance, because the ECB makes it clear that QE should inform forward guidance about policy rates. So if I know I have certainty that policy rates will stay low for a foreseeable future, then I also have more comfort in funding myself long term. And then finally, there's a scarcity channel underway, because ABS and cover bonds are being purchased already and being driven into negative territory. So we see kind of a sandwich dynamics happening at the moment, where the ECB uses sovereign bonds to push investment in risky assets, and at the same time, those risky assets are also being bought. Now finally, let me come to capital market union. The strong reliance on QE suggests that we need a more permanent solution. for financial fragmentation, but also for weak monetary transmission in the euro area. And if I maybe use and enlist a medical analogy, once that sugar rush of QE wears off, the patient, the euro area, should ideally have a stable glucose level and a properly functioning thyroid gland, such that its future life will be, should I say, less eventful, less erratic. Now, capital markets seem to be just a thing, right? Capital markets allow cross-border fungibility of liquidity and investment, and cross-border integration also spurs the broadening of funding channels. So our suggested actions are threefold in a multifaceted strategy. We need regulatory reforms, that's obvious. We need infrastructural improvements, and we need time-bound, risk-priced official sector support in areas where private sources, private money cannot do the heavy lifting. That way we can mitigate the structural constraints. The Green Paper, which was published in February 18th, is the first step and an important one. It puts HQS, high quality securitization, down as a short-term measure, and the consultation process has started already, concluding in June. But it also mentions cover bonds, an integrated covered bonds framework, as a long-term objective. And that's important as well. But we believe more is needed. More is needed. Action items in our view are that we need a more consistent regulatory differentiation across the entire spectrum of asset-based finance, recognizing the complementarities in a better way. Structural reforms, I've mentioned that in the panel, so I won't go into that in great detail. It's all about creating greater consistency about how credit risk is being captured in the system. So credit registries, insolvency frameworks, etc. And then also, and Luca mentioned that in his presentation, widening the eligibility of asset classes, or potentially introducing dual recourse instruments, or whatever name you might attribute to it. Overall, this set of recommendations should be underpinned by a consistent definition of high quality securities for both covered bonds and securitization. So that's all I want to say at this stage. What we need to recognize is that covered bonds and securitization, by virtue of their role in enhancing monetary policy transmission and catalyzing capital market integration, play a role going forward and a crucial role going forward. But that process is a long one and requires dedication, patience, and trust. So with that, I conclude. I thank you for your indulgence. I hope you'll have insightful conversations and a good evening. Thank you.